Good morning. Welcome to YX Insights. This is Yimin. Today is Friday, January the 9th. We're pre-market open. We have just received the non-farm payrolls data. Not much to see really. We have added 50K of non-farm payrolls in December. Net new jobs slightly below the forecast, but not a big difference. Statistically, you can't really derive anything from this variance. The unemployment rate is actually lower at 4.4%, so still pretty stable by the Fed standards. It's not quickly slipping away just yet. And average hourly earnings month on month is 0.3%. So that's also in line with the forecast. A high hourly earnings rate typically drives the core inflation higher for the same month. So that's something to bear in mind with as well. So now looking at the SPY chart, I do think we are on a bullish trajectory, at least maybe before the mid-February. We have a very realistic shot at going above 700, of course, first, and then 720. So that's where my wave 3 target would be in the near term. And we could have some seasonality downturn in this wave 4 after mid-February. So I would get a bit more cautious there from mid-February onwards. Something I am watching very closely every day is the Treasury balance. So the TGA, the Treasury General Account, is the government's bank account with the Fed. So the government, when they issue bills and bonds, they are parking money into their bank account at the Fed, and when they're spending money, then that money is flowing out of this TGA balance. So a high TGA balance generally isn't ideal for liquidity and the market because the government is essentially hoarding money that could have been spent into the markets, into the real economy. And what you typically see is that when the TGA balance goes up, we see a high interest rate on the overnight cash borrowings between the banks. So here is the SOFR versus the EFFR spread, which is the secured overnight funding rate versus the Fed target rate. And you can see that during the month ends, those overnight secured lending rate actually spikes up because the banks are desperate to borrow money due to liquidity issues. So that spread has now come down since the beginning of the year or the end of last year when the funding needs are heightened. So I think now liquidity looks a bit more normal. This spread is all basically minimal now at just 1 basis point. So all of that does give me the confidence that we are going to stay in this bull market for a bit longer, even though we've had a massive run up since the April low. And the near term path should be higher. And I have seen people talking about potential 20% retrace or big pullback in the first half of this year. So my view is that the path higher will never be a straight line in any time period. The extraordinarily smooth equity curve we saw from April to December last year or April to November last year was actually not that normal when we had very little pullback. And that signaled a lot of sideline money finally formed into positions and chasing every dip. We can't really expect that going forward. So now I think the market will be a bit more normal and with more divergence and volatility going forward. So I wouldn't get too used to market just going up in a straight line. And as we saw back in November last year, when there was a little bit of wobble in the S&P 500, actually a lot of high beta stocks went down by 30, 40, 50%, and also cryptos as well. So you will see that investors getting quite nervous at the first sign of trouble and trying to rush out of the door. And that's quite normal because equities tend to climb the wall of worry. So I think overall the path is higher, but it won't be a straight line. Looking at QQQ, so QQQ hasn't been structurally as bullish as SPY in terms of the technical setup. It's been hugging around the 50-day moving average since the November drawdown, and we couldn't quite above this resistance line. So it looked like we could have had a breakout this week, but it went back down again today. So I think the market momentum isn't quite there just yet. But as you can see that we're getting lower highs and lower lows. This is a flag pattern, and we will have a big move soon. And my prediction is that we're going to move higher. And with this wave 3, potentially above 650 to go into the mid-February. So just ignore the timeline that's been mapped here. I just want to show all of the path onto one chart here in terms of space. So it's the price level you should keep an eye on. And this wave 3 target could easily be the 138 to 176% extension of this wave 1 here. IWM, structurally speaking, IWM is way behind SPY and QQQ in terms of the progression since the past couple of years. And the small caps generally haven't performed as well as investors had hoped. But looking at the setup since November, I think this is wave 1 going to mid-December, and we had an ABC correction testing the 50-day moving average at the year end, and now we are having a breakout into a new high, and I think that's very bullish. So I think structurally IWM could have more leg in this rally than SPY and QQQ, and the improved liquidity from the Fed, potentially QE down the line, as well as lower interest rate levels, will massively help small caps in terms of performance. So definitely something to keep an eye on. Looking at 30-year yield, so we've mapped out this ABC leg for a while now after the breakout from the 200-day moving average, and the 30-year yield has pretty much reached our wave C target, which is between 4.89 and 4.95. So there definitely is a possibility it could push a bit higher towards the 4.95 region, but my read is that this is a overall corrective move in this large degree wave 2 of a downtrend. So this is the ABC move, and the majority of this move higher is now probably behind us. So I would be looking for interest in bonds in terms of buying bonds and expecting yields to go lower. But I think this process of directional pivot could take a little bit of time to calibrate. So I will just be a bit patient here. For TLT, we are looking at a wave C bottoming region here around 86 to 87. We've tested this a couple of times and we're still hovering around this level. I think this is a consolidation pattern, and we need to move above the 50-day moving average to be decisively bullish. So I think for now we should be a bit patient and follow our machine learning signals and just do small clips in and out, testing the market a little bit. And one thing I would say is that around the major market pivot, the bottoming and topping processes, the machine learning model is essentially feeling its way through how bullish the market is. So you will see more switches in the signal in this region versus when, for example, SPY just rallied relentlessly between April and October, and it was just a signal of risk on every day. So depending on the market phases, you will get different behavior in the model signal as well. US oil, on the margin, I'm still bearish. So it's very clear that President Trump wants lower oil prices, putting geopolitics aside. He's very interested in having WTI at below $50 per barrel. This is really important, not just because oil is the US is a big oil producer and oil exporter, so it makes a lot of revenue from it, but also it helps reduce inflation expectations and therefore interest rates. And subsequently, that will help the government refinance its debts and prop up economic growth. And a lot of the smaller cap names and high beta names could once again find rallies that it couldn't before. So, for example, when I looked at the relationship between oil and Tesla, it's very clear that they have an inverse relationship. So, lower oil prices actually helps Tesla's shares price, even though from a business angle, lower oil prices might deter people from buying EVs. So just bear in mind, stocks are not necessarily businesses in the short term, and the actual price levels move according to liquidity rates, a bunch of macro factors instead of just the car production levels. Looking at Bitcoin, so we are having a breakout from this trend line resistance, and that looks very similar to what we had in April. The only thing is that we are slightly stalling now around the 50-day moving average. So we broke out, and then now we're doing a retest. So at this moment, it still feels a bit neutral rather than decisively bullish, depending on if we can stand above this 50-day moving average and clear this high. So this week's high couldn't quite get above the December high. So I think that itself shows that the market is trying to get bullish, but the momentum isn't quite enough for decisive breakout just yet. So that is definitely something to watch along with our signals. Overall, I am comfortable with this being a bottoming pattern, and we are probably looking towards a recovery this quarter, but we need a patient process for the market to find its footing. ETH, so very similar, we are seeing a breakout and then now a retest of the 50-day moving average. And overall, it does look we could be moving in the wave 3 path towards 4,000 level, which is a key psychological level. But right now, we haven't actually broken above the December high yet. So for now, I would say I'm medium term cautiously bullish, but in the short term, I just need more price action, positive price action to confirm my thesis. Solana is actually, it looks similar in the near term to ETH. So it's breaking out of the resistance zone and it is challenging the high of December. But if you just look at the ranges, we are still not decisively above the November-December highs. So you can't get extremely bullish just yet. And there is a concern that we could have one more low given the shape of this dive. But truth be told, Elliott wave doesn't apply that well on cryptocurrencies, which are newer commodities or markets. And in terms of volatility, they're much higher. So I wouldn't be too fixated on where this C is relative to A, or whether this A should be labeled a bit higher, etc. I think the important thing is just to watch how the price breaks out of this high volume region and against the December high first. So still very early in the recovery, promising, but not decisive as well. XRP. So XRP looks to be a bit more promising in terms of relative strength compared to the other coins. We are having a quite big run up into last week's high, and then since then we've had retraces back towards the 50-day moving average as well. So XRP is a lot more volatile than ETH and Solana. So I would just position, in terms of risk management, I would really consider the volatility and position accordingly. There is a big volume profile in this region, which XRP couldn't quite get above. And also there's a 200-day moving average here. But overall, it does look pretty strong, definitely more so than Solana, and even in comparison with Bitcoin and ETH. Coinbase, I think there's a good chance we completed the low here just before the new year. And this wave 5 in the end only exceeded this wave 3 by a small margin. However, we're under the 50-day moving average. We're also in the bottom half of this volume profile. So I am also a little bit cautious in calling the bottom just yet. And I just want to see more decisively positive price action from Coinbase first. I think Coinbase is actually a harder name to trade than Bitcoin and ETH, because it trades a bit like a halfway house between Bitcoin and ETH, but then also it has the equity element, the earnings element to it. So the corporate events where you see big spikes or drops around the earnings dates. So in a way, it is a crypto proxy in equities, but a bit trickier and with higher volatility as well. Robinhood. So I actually don't have that much comment since last week, because this is a very clear ABC correction, and that could have put us to the end of this wave 4 here. We are seeing a higher low compared to this low with higher RSI levels as well. If I were to enter here for a try, I would have a stop around the 100 level and targeting potentially the wave 5 region around 200. To me, this does look like an accumulation, because we have had quite a big sell-off since October in the crypto land, and I would say that price has held up pretty reasonably for Robinhood, and there's a lot of volume building in this region as well, and that to me looks more like accumulation rather than distribution. So I think there should be one more leg higher, and that corroborates with our broader crypto expectations and broader market expectations. Strategy. So our machine learning model is actually taking shots at trying the long side here. This wave C has basically extended by 120% of this wave A, which is the lower end of the target region. So all of that, no surprises yet. And we are just really looking for the first sign of life by getting above this 50-day moving average, which is also a big volume profile region. But in reality, I have a sense that we could be consolidating a little bit more here in terms of the price action, because we just had a new low, and there is a lot of interest in this region in terms of volume, and it could take a bit more time to resolve. So I'm quite interested to see how this chart plays out. If it goes straight up, I'll be pleasantly surprised, but that is not my expectation from experience. BMNR, so we managed to hold the November low. I think the critical region here really is the VWAP from mid-October onwards, so from this October high. because BMNR tested this VWAP in December and couldn't get past it. And it went straight back down to retesting the bottom, which has held. So I'm bullish in the short term, but I really want to see BMNR getting above all these moving average indicators, the 200-day in red, 50-day in blue, and the VWAP from the October high in black. So I think if we can get past this and ideally take out the December high, it is a big positive sign for actually moving towards this wave 3. With BMNR, is a very volatile stock. It's more volatile than ETH and SBET. So if it does make this breakout, it could actually happen quite quickly in just a few sessions. So I think from here, I personally would wait for my Ether signal to turn positive, but also position myself where the stop loss is reasonable around the low end of this bottoming region. So I'm protected on the downside. SharpLink is much smaller stock than BMNR, but they have a very good combination of CEOs, where one is the ETH co-founder, and so he knows the crypto industry inside out. He knows the ETH roadmap very well. He knows all about the staking yields, everything you can do to provide the extra juice for the shareholder. And then you have an ex-BlackRock executive who raised the crypto ETFs, so he understands the big money institutional side and the investor demand side as well. So marrying the technical knowledge, the insider knowledge of crypto versus the insider knowledge of Wall Street, that's a very potent combination. So I wouldn't necessarily prefer BMNR over SharpLink. In terms of the price action, SharpLink is trading at below 1 MNAV, so below its book value. So it's a quite reasonable bet to go long here once the ETH signal turns on. And I would just watch for the first sign of breakout from the 50-day moving average. I think 16 will be quite difficult hurdle, so that could provide us with the first pullback or a second chance for the dip buyers when it happens. So 16 is the 200-day moving average, so just around 15, and also the beginning of this volume profile where a lot of people bought over here and potentially want to offload. So I would be a bit cautious once it approaches this level. But over here, I do think if you're overall bullish on crypto, and when the signals start to align, is a reasonable shot. Gold is consolidating a little bit. It hasn't hit a new high in the past week. There is some index rebalancing chatter about the commodity indexes having lower factor for GLD and LSLV. But I think in terms of experience, those short-term factors don't really matter that much in the long run. I think in terms of index, the only big issue is when a component gets introduced or kicked out, because when they get introduced to the index, of course, all the passive funds are buying. That provides a lot of liquidity to the name, even if it has run up a lot, because the passive funds are not price sensitive. Whereas if the component gets kicked out, of course, it loses all of that liquidity, or the passive funds have to sell. So outside that arena, I wouldn't get too fixated about the index with balancing, etc. That would be more of a short-term thing, and I would just follow my machine learning model and chart analysis on the overall trend. So I do think we are likely on the path for wave 5 here. And that wave 5 can reach for 30-year plus. Gold miners have been a bit more bullish than GLD, relatively speaking. It's making new highs. And we are looking for a wave 5 high just under 100. I think high 90s is definitely a very feasible target. Else, SLV, of course, this name can just keep running higher. There's no rule book saying that something can't go more parabolic just because it has done already. This wave 5 does look pretty extended, and even if you consider how far we are from beginning of this wave 5, where we traded in the 40s, and now we are more than 50% higher from there as well. So that is a really big run up in a very short space of time. So I'm a bit cautious. So our machine learning signal has been risk on for silver. So we have benefited from holding on to that position. But when it starts to turn risk off, I will just be a bit more cautious than before. And again, in this topping process, when the market is trying to find pivot, the model will become a bit more neutral. So it will throw in a bit more risk on, risk off signals more often. It's going to switch a bit more often in this topping process, which signals a neutral consolidation pattern. But that in itself, I think, is very useful as information on how machine learning thinks about the overall market phase. So silver miners, I think feasibly we could get one more high. I don't think that is a big stretch of imagination. It depends on where this wave 4 lands. And of course, SLV could go more parabolic at the same time, and as silver miners follow it. But overall, I do think we have run up quite a lot, and I would have quite strict risk management process around these levels. But overall, I don't think we are too stretched for this for silver miners just yet. There is a bit more room towards 100 level in this wave 5. Palladium, PALL, this wave 4 retrace reached above the 23% retrace of this wave 3. So it has fulfilled the minimum threshold for wave 4. So of course, this could still be an ABC correction for a deeper fall to touch the 50-day moving average, which it has done before. So the 50-day has been quite reliable support in the past year. So it's possible we get ABC here and then final wave 5. But let's say we don't get that correction and therefore not that dip opportunity anymore. Wave 5 from where we see here could still reach above 200 to complete this cycle. Platinum, PPLT, it has just basically gone up in a straight line since we covered it. So from here, the risk of topping is getting quite severe, and we could retest a bit further into the 170 mark for a retrace of this wave 4 and a retest of this 50-day moving average. But in the short term, the market momentum is pretty strong. One thing I would look at is the platinum versus palladium ratio. So these things industrially are considered very similar as substitutes. When we get platinum moving substantially above palladium in terms of price per ounce, we tend to get a mean reversion here. So in that sense, when we just look at our two charts, platinum has a bit more risk of topping and further retracing against palladium, which seems to have a bit more room in its run up. So this ratio could head towards this 50-day moving average again. Max 7s. So Apple was one of my favorite stocks since August, September with the iPhone 17 results that have been pretty positive compared to this time last year. However, we are seeing a breakdown of this head and shoulder pattern, and therefore a potential conclusion of this wave 5 here of this wave 1. And our machine learning model has turned risk off since this week. So I'm a bit cautious here. This could easily be the wave A of the downturn, and we get a wave B rally, and then a further decline to test the 200-day moving average. We are at an RSI 30, so the market in the short term is oversold. I suspect there will be some dip buying actions here, also coinciding with the volume profile around the 250 to 260 region. But overall, I don't think the bullish trend is still intact, and I am very cautious that this could become a sell the rally regime. Amazon, we finally get a risk on move here and a breakout towards the wave 3. We've cleared the December high, and now we're challenging this all-time high. With Amazon, we need to be very patient, almost. The same price here today, we already saw it back in 2025 at the beginning of the year. So you could say that in the past year, Amazon stock hasn't gone anywhere, and that frustrates a lot of people. But I do think this was accumulation, which we seem to have correctly interpreted, and we are looking at this wave 3 of wave 5 towards the 270 level next. And this breakout does remind me of what we saw before when back in August. So what happened in August, that we had a sharp sell-off, our machine learning signal turned risk off to protect capital, and then we had a massive bounce a couple of days later, and then we rallied towards 240 again, so, which was a new high at the time locally. So similarly, we had model going risk off around those days just before the year end. Then now we are seeing a breakout and the model turning risk on. So that did feel very similar, and even if we get to the same sort of level, that would still get us towards the target 3 above 200 and towards 270. Google, so incredibly, our machine learning model hasn't had an off day for Google yet. So it's been holding on to Google since last summer. And my previous thinking that we should be looking at ABC retrace of this wave 4, and that could test the 270 mark, but it's such a bullish stock, every dip gets bought. So I'm actually not 100% sure whether this is still a wave B or not. It's not that obvious. So it could still be an expanded flat, but in any case, this is a pretty constructive pattern for preparing for wave 5. Meta, I think Meta's chart is just really not very clear on what it really wants to do. So I have been of the opinion that we could be in a 5-wave down pattern in this initial leg of sell-off, largely driven by the capex concerns. So Meta spends something like 30% of its revenue building AI data centers, and investors really have a lot of doubt on whether that revenue will we can see accelerated revenue on such big spend. What we see here is that for the past month, so since beginning of December, we're trading in really tight sideways zone between 630, 635, and 675. So that's even within 10%. And it couldn't quite above the 200-day moving average. So in that sense, it's still quite bearish looking. And my thinking is that even if this is not 5 waves down and this is actually wave 1 up, and we still need to get a wave 2 correction towards the 600 level for a setup. So here I'm actually not really enticed to chase right now, and just see how the chart develops from here. So for Microsoft, we are seeing sideways actions, very tight range since late November. And I'm trying to get this wave 1 expectation going, which could challenge 510, where there's a big volume profile. But the stock actually just doesn't cooperate. It's just moving sideways and now kissing the 200-day moving average. So I think there is not really much to play here until we get a breakout and retest. That will give us the 1-2 setup in terms of the technical side. NVIDIA, I explained last week that actually NVIDIA likely to be in the wave 4 retrace. There could be one more high next. Since then, our price action has just basically gone sideways above this volume profile around the 50-day moving average, but not really showing its hand. So for now, I don't really have a particular short-term read on how NVIDIA could behave. If we get a retrace here, that could then get me to start thinking about the 1-2 setup towards the next wave higher. So Tesla, very interesting that machine learning model is actually bullish on Tesla despite this sell-off. So it did switch to risk off 2 days before the new year, and then now it's switched to risk on in the past couple of days. And what I think is happening could be that because of the oil prices, that had a quite big inverse relationship with Tesla over time. So the things that's happening on the oil side could be giving some early confident signals for the model on Tesla. So I think that could definitely be a contrarian play at the moment. I personally would have a stop just below 400, so a bit wider than this 78% retrace. Because there's actually not a lot of volume support here. So if we get down, we actually could have slipped through to 200-day moving average quite quickly. And I wouldn't want to have it as low as this 380 level. I think that's a bit too wide in terms of risk reward. So I think 407 or even 400, where it's a psychological level, is reasonable. But truth to be told, if we break below here, then this wave 1, wave 4 starts to overlap, doesn't look too bullish. And it could be that actually all of this is just the initial wave 1, and then we're having wave 2 retrace towards the 407 level. And then actually this is not wave 5, this is wave 1, 2, and we're going much, much higher over here towards 600 plus. That is quite an ambitious expectation right now, so I wouldn't have that as my expectation just yet. I want the price action to prove to me that could be the case. Palantir, I think we are seeing a head and shoulders pattern here that could be forming, but it's not decisively bearish until we really break down through this neckline where there's the 200-day moving average and the high volume profile, etc. So tentatively, I have put in this weight ABC expectation, but I wouldn't be shorting the stock here in a broader market that could still be going up. APP, I definitely think there's a chance that we are seeing the final wave 5 of this 5. And that could take us towards the 1,000 level. It has been a pretty bullish stock in the past couple of years, so there is a big following for this stock as well for dip buying. But structurally speaking, this does look like the wave 5 of a large degree wave 5 here. ORCL, technically it could have completed wave 5 here, although short of the our normal expectation. But still, this does look like a fairly clean 5 waves down. But that also means next wave up could be just a B wave, which is very hard to trade. For now, I'm just going to watch how this stock plays out in the short term. CrowdStrike. So I wrote an article yesterday analyzing CrowdStrike's fundamentals, quantitative analysis, covering a lot of the detailed angles that you wouldn't see just from looking at the chart. One thing that is really interesting is that every time, on average, when it hits ISI below 30, the forward 3-month return is about 20% on average. So that is a quite bullish signal. I personally would target around the 700, 730 area for this wave 3. And I would personally have a stop just below this wave 2 low around 400. So if we travel below this level, then this projection is probably invalid, and we're way below the 200-day moving average, and we can quickly slip into the 360 regions, and I don't like that. So I think if we don't get the positive price action and fall below the 400 level, there'll be quite important loss cutting area. But otherwise, overall, I'm pretty bullish crowd in terms of technicals, and the valuation is a bit more neutral, but it's definitely off the highs of November and July, and is closer to the median of the past 3 years in terms of EV versus sales. So given this name always trades with premium valuation as a growth stock, if its earnings can stay above 20% growth rate, which it will, I think overall the projection should still move higher. Cloudflare is not quite as bullish. As you can see, that this does look like a head and shoulder pattern. We're now standing at the neckline here, and then even in the short term, the best case scenario is we find a bounce for this wave C of B, and getting lifted by the 200-day moving average. So you're hoping for a lot of short-term buyers to come in around this level, and we can hold this wave A low. And if we break below this wave A low, we might be traveling to wave C in a more direct fashion. So overall, I'm still quite cautious. I think if one wants to trade against this wave C of B expectation, then it still really warrants having a stop below this danger zone, I would say. SOXX trades very similar to SPY, surprisingly, more than NVDA or AMD, and it is on a very bullish path, and I don't really see a lot of resistance ahead of it moving towards 350 next. Broadcom, I think the price action has been weak. So this chart actually does remind me of the Cloudflare chart we just saw, where this could be just wave A, and we are looking at a ABC corrective rally towards this wave B. It's not a rally I would want to trade, so I would be a bit cautious. And if I were to trade this, I would definitely have a quite tight stop just below this level, because once we fall through here, we could be looking at gap fill towards 307, and of course the 200-day moving average towards 300. ASML, pretty bullish chart. We're seeing new highs in the past week, and this wave 5 can easily stretch towards 1,300. But I would say the great majority of this move does look complete now, so the risk reward doesn't look that great from this level. ARM Holdings, so in the past couple of years, is basically traded in a very wide range. We're sort of in the middle of that range, and optimistically, if this was an ABC correction, then we're looking at wave 1 with the 5-wave pattern over here, and we could be looking at wave ABC correction that ends the wave 2 around 100. So I think this sell-off could be mostly done. There could be one more exhaustion leg, But right now, I really want to see positive price action to kick off the next bounce. Finally, AMD, I'm just a bit cautious that we could actually get a gap fill here first towards 171. So typically, not all gaps can be filled, but most are. The gaps that don't get filled are breakaway gaps at the beginning of a rally, where we are seeing a pivot point where some big catalyst has permanently lifted the stock out of that previously bottoming range. So it doesn't get retested. It doesn't have to get retested. But here, it doesn't really look like a breakaway gap. So this was the ChatGPT AI deal with AMD. Overall, I do think there is a lot of potential for the next wave 3 higher, but this wave 2 is by far not certain has finished. It could easily be a wave 2 down at 167 level where the gap would have finished. So I'm just a bit cautious that we can retest this high volume region as well. That's 200-day moving average. But if we do get here, it does look like a compelling buy in terms of long term, assuming one makes appropriate risk management. So that's it for this week. Thank you very much, and I will speak to you next week.